Well, Asian stocks are following U.S. and European equities lower today. That's before an expected interest rate hike by the Federal Reserve. Let's bring in Steve Davies. He is the CEO and founder of Javelin Wealth Management. Steve, we know at this point in time that a rate hike is pretty much a certainty, so we're left to kind of look for the second order effects. On that note, I want to talk about the dollar, because normally when you enter a hiking cycle, you see the dollar strengthen. That hasn't really been happening this time. What is it going to take to move the dollar significantly?
Well, I think it will require a number of things. It would require probably a rather more hawkish stance coming out of the Fed in terms of their statement today and in subsequent weeks than, quite frankly, the market is currently expecting. But also, don't forget that for the dollar to be strong, another currency has got to be weak, and that really all depends on other developments around the world. So certainly as far as the euro and sterling, it would have to all be about politics, and we expect that to remain relatively negative, at least on a medium-term view, and for the dollar to gain against those currencies in the coming months.
What about the dot's trajectory? How much steeper will that trajectory have to be for the dollar to significantly see a pop?
Yeah, I mean, we're not really expecting too much of a change in that dot's trajectory. We're expecting, as it actually has been the case for really the last couple of years, for the Fed to telegraph its intentions very clearly and not to really depart significantly from the fact that they remain data dependent, and that will continue to guide their policy stance. And what we're expecting to hear is that the economy continues its gradual gains. We are expecting to see an indication of further tightening throughout the remainder of this year, but that any further increases will depend on data at the time. So no change from what they've been saying.
Yeah, Stephen, Shery brought up a good point there, which is everyone is going to be focused on the path of future rate hikes. Speaking of which, we do have some people talking about U.S. Treasuries potentially moving to 3% on the 10-year if we get a more hawkish than expected Fed. Where do you expect the U.S. bond market to be going now?
Well, we would expect that yields will gradually rise. We're not anticipating a rise to as much as 3%. And that would require a much more hawkish stance than either the Fed or has prepared for or the markets are expecting. So we're anticipating that we'll see a gradual rise in yield. That's the way that our portfolios are structured, but not expecting to see a much more aggressive stance than is currently priced in.
Given the higher rates in the U.S., how much of a problem will this be for EMs?
Well, actually, the interesting thing with EMs during the course of this year has been the fact that they've actually marginally outperformed U.S. markets, partly because local currencies in emerging markets have recovered relative to the dollar, and partly because from a macro perspective, emerging markets are actually looking reasonably positive. So it doesn't look as though the traditional linkage between rising U.S. rates and emerging markets, at least in the short term, has come to bear during the course of this year. So actually we're anticipating that position will continue, because if you look at the country level, the story for places like India, Vietnam and other emerging markets actually continues to look pretty positive. So that's a strong underpinning.